In this recording, we're going to go over debit credit rules. So let me quickly kind of go over the whole process of analyzing transactions. We know basically that transactions take place for a business entity. We have economic transactions take place. We also know that the outcome of the accounting system is to have these four financial statements: balance sheet, income statement, statement of changes in equity, or statement of changes in retained earnings, and then also the statement of cash flows. So there's really a process. We've got to go kind of funnel all of these huge volume of transactions, kind of funnel it through the accounting system, analyze, record, summarize all of these transactions. So our process is somewhat of a funnel, so that the output are these four financial statements. So what the accounting system or department will do is capture the raw data. So these transactions are inputted into the accounting system. In the real world, we know that there are documents created when these transactions take place. It could be a sales invoice or a purchase invoice. It could be the company receives a bill, there's a sales slip, deposits in the bank, checks written to the bank. But these could be physical documents or electronic documents. A copy of all of this goes to the accounting department, and the accounting department then will process it. So let's go through where the accountant will process all of this. We've already looked at half of the analysis. So in part 1 of chapter 3, we learned to analyze the accounting transactions in terms of assets, liabilities, and stockholders' equity. That's where the real analysis takes place. The second part, though, is assigning debits and credits. You probably had a sense that if we had just used the horizontal model, it can get that Excel spreadsheet can get really, really large, and that would become overwhelming. So there's really going to be a second step to processing transactions where we're going to assign debits and credits just to facilitate the processing. Again, I want to emphasize the real analysis takes place here, and in terms of things that really have a meaning and make sense. The debits and credits are really a way of processing transactions to facilitate it. Think about it. If we had 500 accounts in the accounting system, and there could be even more than that, if we had 500 accounts, think how huge that Excel spreadsheet would become. So that would become overwhelming. So to simplify the process or slim it down and make it more doable, we include these debits and credits. So there really are two accounting equations: assets equal liabilities plus stockholders' equity, and then debits and credits. So let's look at, well, what do I mean by debits and credits? Well, debits and credits don't really mean anything. I stopped things real quick and kind of focused on the second page of your notes. So we know the income. So let's review the three financial statements. We know that revenues increase net income. So revenues are positives, and then we subtract expenses to arrive at net income. The second financial statement we prepare is a statement of retained earnings. Those are the earnings that we keep or retain in the company. So we know that net income is going to cause retained earnings to go up. And then if we distribute those earnings, right, that's a dividend. Dividends are just a distribution of earnings, so dividends reduce it. And then we arrive at our ending retained earnings. On the balance sheet, we have assets, liabilities, and stockholders' equity. Under stockholders' equity, there are two sources: common stock, that's the investors' or owner's investment via common stock, and then we have retained earnings. Earnings belong to the owners or the stockholders. So after we prepare our statement of retained earnings, that's going to flow into the balance sheet. And then we know that total, if I were to total our assets, is going to equal the total liabilities and stockholders' equity. So again, we have assets equal liabilities plus stockholders' equity. Under stockholders' equity, we have common stock and our retained earnings. Retained earnings goes up for revenue. I'm just going to abbreviate revenue, REV. It will go down for expenses. And then also dividends reduce retained earnings because we're distributing our earnings. So we're not retaining them, so they're going out. Okay, we have studied this horizontal model. What we're going to do now is, so that's the first accounting equation. Let's add in the second accounting equation, because what makes this complex is the two equations have to stay in balance simultaneously. So we know if we increase this side of the equation, the other side of the equation has to go up as well. So what we're going to do is say that, well, if it goes up, we're going to call that a debit. So notice debits don't necessarily mean anything. It's just that I'm assigning it a name. So we're going to say if this side goes up, we're going to call that a debit. And if this side of the equation goes up, I'm going to call that a credit. So then debits equal credits. Likewise, if this side of the accounting equation goes down, the other side has to go down. And we have to keep it in balance, to keep it equal. So if this side goes down, I'm just going to call that a credit. And if this side goes down, I will call that a debit. And by the way, the abbreviation for debit is DR. The abbreviation for credit is CR. So CR and DR. And that is our debit credit rules. This side of the equation goes up with debits, it goes down with credits. This side of the equation goes up with credits and goes down with debits. And so the two equations stay in balance simultaneously. Okay, so let's apply our debit credit rules. By the way, debits always go on the left, credits always go on the right. You can kind of remember that by the idea of Washington, D.C. Debits left, credits right. I know it's kind of corny, but it'll help you remember it. So every account, debits go on the left. Okay, debits go on the left. So if I have these T accounts, we use T accounts in accounting because of the debit credit process. So debits will go on the left side of the T, credits go on the right. So debit, credit, debit, credit, debit, credit. So debit's always on the left, credit's on the right. And go ahead and fill all of them. Okay, so fill all of them out. Debit, credit, debit, credit. Okay, so every account, debits go on the left, credits go on the right. Now let's go back and review. We said assets go up with debits. So that means assets go up with debits. But we said the other side of the equation goes up with credits. So liabilities and stockholders' equity go up with credit. These are the debit credit rules for assets and liabilities. Assets go up with debits, but the other side goes up with credits to keep it in balance. And then just the opposite. Assets will go down with credits. The other side of the equation goes down with debits. Okay, now we're going to complicate it a little bit further. Let's go to stockholders' equity. Stockholders' equity has the two sub-accounts, common stock and retained earnings. Well, common stock's going to go up with credits, just like the total stockholders' equity. Each of these will go up with credits. If for some reason we need them to go down, they'll go down with debits. Let's fine-tune this. Retained earnings, though, right? Retained earnings has three subcomponents. Let's go back and review. Retained earnings goes up according to our financial statements. Revenue causes it to go up. Expenses and dividends cause it to go down. So, under retained earnings, then, revenues go up with credits. However, expenses and dividends cause it to go down. Retained earnings goes down with a debit. So, expenses and dividends are we going to create these accounts with debits. So these accounts will go up with debits. By causing them to go up with debits, it will cause retained earnings to go down. That gets a little confusing. You'll have to put some thought into that. So again, revenues go up with credits. The other two will increase with debits. So revenue is going to be a credit and expenses are debits. Okay, so that gives you the debit credit rules. The next demonstration problem recorded will show you how to apply that and actually make journal entries. So we've gone through how to assign debits and credits. We're also going to see here in the second part of chapter 3 how to make journal entries. A journal tells the story of the company, but it's going to be written in debit credit format. That's why accounting is often referred to as, quote, the language of business, because the language is in debits and credits. So we're going to make journal entries. And again, think of the journal just like, your diary or personal journal. It tells what happened in chronological order. Then we're going to post to the ledger. There'll be a trial balance. And then finally, write out the financial statements. But again, all of 2 through 6 will be demonstrated in a demonstration problem.